baby, we're back at it again, just crapping on the dividend investing community, which irks my passive income investing soul. As obviously these tech companies are propelling the indices back to their all-time damn near highs, and I want to break down SCHD, my concerns, some strategies I'm working on with it, and then we'll look at some actual individual dividend stocks. I got 3 for you that fly under the radar that I want to start accumulating at some point in the next, few months. I want to figure out how I can work it in there, but I'm sure you've seen videos just like this.
What is going on with SCHD? In a year where the S&P 500 has appreciated by almost 20%, SCHD has stayed completely flat. In fact, it has lost almost 3% in value. That is a large difference. But how come? Why has this ETF not seen any sort of growth in 2023? Well, in reality, it's not just SCHD. It's actually majority of dividend ETFs like SCHD that have this problem, like PEY, VYM, DVY, HDV, etc.
So in a world of slower growth, obviously the bottom half of the S&P hasn't been keeping up with the tech companies that are more AI technology based, where those people have just been throwing money in those 5 or 10 tech companies that has basically propelled the S&P 500 to these wicked gains this year. And I never recommend putting all your money into dividend stocks. I'd never say that. I mean, that's not a logical solution to a long-term retirement plan, considering in moments like this when the S&P is damn near 5% off its all-time high just because of that handful of tech companies. You want that exposure, right? So I hold some tech companies individually, myself, my fiance, but I also want to start buying those dividend companies. I'm going to explain to you why, where they make sense, but it's not fair to give a 1-year price performance on any investment. Typically, if it's underperformed, that might mean it's a good buying opportunity. We just saw that with bank stocks. They're rallying aggressively today after I made a little bit of fun of Steve Eisman yesterday because everyone just crapped on them. They beat them into the ground, and all of a sudden they're rallying. Bank of America is up like 4 or 5% today. JP Morgan, all these companies, the bank stocks in Canada have been doing exceptionally well here. So you need that diversity. But SCHD, guys, you can't just say it's a bad ETF. I mean, yeah, it's down 9.88% since the peak of 2022, but damn it, you got to throw over 3.5% yield. If you bought the peaks and troughs, you're really down probably less than 5%. Let's be real. And obviously the Discord and the YouTube investing community has been really fixated on this ETF because of its damn resiliency. It's a great place, in my opinion, to be buying it. I love buying it. It's why I own it in my RR to the S to the P. If you're a US investor, I'll teach you something, a little tidbit of advice here. It sucks because if you're buying over the border companies, even from the US to Canada or the Canada to the US, they charge you a 15% withholding tax, which just sucks. So it doesn't make it worth buying dividend stocks over the border. But Canada gets this benefit in this tax sheltered account. The government waves their magic wand and says, guess what? We're not going to charge withholding tax in this account, so you can make dividends and capital gains tax-free in perpetuity for as long as they're invested in this account. The problem, however, is when you draw against this account, unlike the TFSA, you permanently lose that contribution room, which kills my soul because I perpetually never want to sell off my entire RRSP, do I, when I decide to pull these funds out? So what you do is, what I like doing is buying things like SCHD and dividend companies in the US because I can collect those dividends and obviously pull them out of the account without touching the initial investment here. That's my goal at the RRSP, right? And I've been hearing a lot of people, and he's not making fun of us here, he's just pointing out a fact that I've been hearing a lot of people that make fun of dividend investors point out.
A lot of people think that dividends are just extra money, free money. They are not. If they come out of the business's bank account, it decreases the balance sheet's value. That's the big thing I want everybody to remember.
Now, if you're a complete noob to investing, this isn't freaking rocket science. It's not a negative to buying dividend stocks, but yeah, on the ex-dividend date, you'll notice the stock will actually drop based on the dividend they're going to pay out for that quarter. But if you're a mobster like Pepsi making that Dorito money, and when that Dorito money comes in on a quarterly basis, they distribute it to you. And yeah, the stock drops, but it's always replenished by the future cash flows of a good freaking business. And it's good to have that diversity in your portfolio because tech stocks, Meta, some of these companies that don't pay dividends, they think they can reinvest the capital better than you. And yes, on a lot of times, the circumstances they can, and you'll get better performance. But however, in recessionary environments, like from the dot-com bubble to 2008, there was no gains in the S&P 500, even though cash flows and revenues were probably going up. That doesn't always mean the stock's just going to go up because their cash flows are going up. The market's pure fugazi in some circumstances, which leads to discounted values and buying opportunities, which is exactly why I think a lot of companies in the Schwab US Dividend Equity ETF are potential buying opportunities because they haven't kept up with those tech companies. The yields are higher than they have been in the past, and a lot of the companies in here are diverse, and some of those are financially related. And I think because financial stocks have started to rally back, that has been starting to drive this ETF up a little bit. But you get great diversification, like 100 different dividend companies. You get growth, the combination of growth and dividend. I love it. I don't think you can do any wrong. But let me use an example here of one of these 3 dividend stocks that have dramatically outperformed during recessionary periods. I think they're still great to buy here. They're expensive, but they're always going to be expensive. So just buy the ups and buy the downs and know you can hold on to this for the next 100 years and send it to your grandkids, your grandkids' grandkids. It's a generational type of company, and that is Hershey's. Hershey's is astounding, and I want to show you why these kind of companies are astounding and why they are better than growth stocks in certain periods. Basically, from the dot-com bubble, the peak, all the way to 2008, that financial crisis, this stock dropped a mere 3%. It barely dropped at all, and then within less than a year, it was rallying back into the green, let alone the dividends you would have collected over that time frame. Whereas the S&P 500, during that time frame, the dot-com bubble didn't see any capital gains, barely pays a dividend, and you would have been down 54% over a decade. You know how painful that is? This is why there's resiliency in having a diverse portfolio in these kind of dividend stocks. And Hershey, yeah, it doesn't pay a high yield, damn it, but at 1.73% it has over doubled every 10 years. You give it 20 years and you're sitting in a very healthy cash flow, an initial yield on cost position, right? I've been wanting to own this. I've watched this company forever, and they are a conglomerate. Elon Musk has made fun of them for being, a monopoly. I love duopolies and monopolies, companies that have real moats over industries. This owns every holiday that you enjoy if you eat candy. Christmas, you like Valentine's, you like Halloween. All of these holidays have no exception but to use Hershey these days. And when you look at the brands, you might be underwhelmed. You're like, I don't need a lot of these. These aren't crazy brands. Yeah, Reese's is cool, Twizzlers, sure, if I go to the movies. But the fact is they have licensing agreements, and that's what makes this such a damn resilient company. Is I love Cadbury mini eggs. They're like one of my favorite chocolates of all time, and this company owns the licensing rights to produce that in the US. That is where this company has a true moat in most of the candy industry. They have a place in almost every major candy brand, pretty much every major candy brand. I love them. I'd love to own them. But look at the other spectrum here too. Like, look at Public Storage. I love this REIT. It's something that I've wanted to buy for a long time. I've been following it. It's been trading down because the higher interest rate environment has been beating it up by 30%, which again, I like. Do the opposite of what anyone ever says in the market. It makes more sense. They hate tech stocks. Tech stocks are tanking, buy them. They hate bank stocks are tanking, buy them. I honestly think that is the new rule of thumb when it comes to Wall Street and CNBC. But Public Storage, it's a very simple to understand thing. They sell public storage. They buy land, they build public storage, and in a world where obviously like these metropolitan areas are ever getting tighter and more expensive, people need space to store stuff. We see it with things like smart centers. They have some public storage exposure here in Canada. But look at the performance. And even during the dot-com bubble, this thing just plowed. It's just plowed recessions like it's been nothing. Obviously, there's some volatility, but it performs against the market, which I like. So if the market's going up in periods like this, we can see it kind of going down, but it has led to some pretty stellar outperformance. And the thing that I love over many REITs compared to this one, not only is it a pure play, but it keeps damn well growing. Look at this, 773 million to 848 million, sorry, for the last quarter. Not this last quarter. We're waiting for those results. I'm very excited to see what the second quarter looks like. What makes this also very intriguing to other REITs, 17.5 billion in assets against 6.8 in liabilities. They have a lot of cushion room to deal with this higher interest rated environment. This is one that I've been following for a while. I might start buying it at some point. I think it's just one of the best REITs I've ever come across, to be honest. And let's talk about another consumer staple, brilliant company. I've analyzed so many dividend investors, Gen X, PPCE, and all these guys are into your McDonald's and your Starbucks and your Microsofts and your Apples. Those are all great dividend companies, but Pepsi, I think, takes like the cherry on top of the cake for some of like the most stability, resiliency. Yeah, the yield has fallen off a little bit because it's been growing. They just posted earnings and they peaked, but now they're selling off from those earnings because those earnings weren't that stellar, to be fair. And I think Pepsi's a way better pick over Coca-Cola because Pepsi's brands are just more diversified, in my opinion. I mean, they got licensing agreements across the board. Lay's, I love Bubbly. I mean, I just love their product lineup, and Doritos are one of my favorite chips of all time, obviously, which they're too expensive now for me to buy, so I stick to the dollar chip aisle at Walmart. Yes, I'm still that frugal, but I get that people continue to buy these regardless of what they're charging for it. And if we take a look at the earnings here, guys, they had record revenues over the last, the record revenues for the last quarters, but the problem is that their operating profits have been falling off. We can see that their operating profit was actually pretty good for the last quarter, but for the 24 weeks, it's actually been declining slightly. And on the EPS standpoint, they've actually been declining over the longer period, but for the last quarter over quarter was pretty good. They're sitting at $1.99. This company will always be resilient, always have a staple to society, and I love these kind of dividend stocks here. So these are the things I'm taking into consideration as I rebuild back my portfolio after selling off a huge percentage to obviously buy some real estate, which I think is really great to get that foundational start in the real estate market. But I just can't help but believe dividend stocks are probably one of the truest fundamentals to building out a retirement portfolio, but that shouldn't deter you from diversifying. Obviously, I own a huge percentage of the S&P. I love my Schd, but I do want to start building that 10 to 20% of my portfolio back in these individual positions. But I'll pass that question off to you. What do you think about this in that comment section below?